Good morning.
Good morning, Keith.
Okay, sorry for a little bit of a delay. I think I woke up late today. All right, so today let's talk about some strategies, techniques you could start using in attacking the markets. I believe we have covered enough ground with you from the beginning. And now it's time for you to start combining as many things as possible to start placing trades. Let me first inquire, you know how to place trades, I believe?
Yeah, doing the direct bar.
You understand? For example, if I
Yeah,
give you this chart, do you understand all these things?
yeah. The limit by
Yeah, buy limits, sell limit, buy stop, sell stop, stop loss, you know those types of orders, right?
yeah. Yes, I do.
All right, so then we'll just go straight to the strategies. I want us to talk about, if time allows, we'll do all the 5 strategies today, but otherwise we'll do 2 or 3. So strategy number 1 will be engulfing strategy.
Mm-hmm.
Engulfing. And this is purely based on the engulfing candlestick pattern.
Mm-hmm.
Strategy number 2 will be based on pin bar strategy. Pin bar strategy, remember, a pin bar could be a hammer in a downtrend or a shooting star in an uptrend.
Yeah.
Number 3, we look at inside bar strategy. Okay. Number 4, we will look at a trend line strategy. Trend line strategy. Number 5, we will look at a breakout strategy. Breakout strategy. So those are the strategies I would like us to look at. Now, you'll be surprised we have already looked at these strategies, but you may not have realized we have looked at the strategies. Because I have a way of teaching. When I'm teaching, I end up talking about many things. But now I want you to know these are special techniques you could actually use when dealing with the market, when trying to trade. So we'll go through each of them, and you will get what it is, and you'll ask your questions. My hope is you'll be able to master them and start using them as soon as possible. So straight away, let's head over to strategy number 1. Now, strategy number 1 is based on the engulfing candlestick pattern. Let me remind us of what the engulfing candlestick pattern would look like. Let's get the bullish engulfing. Now, remember, signals could be bullish. They could be bearish. Bullish if they predict the market's going up. The signals could be bearish if that kind of a candlestick or a pattern is trying to tell that the market will go down. It's important to know that. And each candlestick has 2 signals. It has a bearish signal, it has a bullish signal. Almost all of them. For example, this is a bullish signal. Whether it's red or green, it's bullish. It's saying the market is likely to go up. The same thing here, but now inverted. The reverse of this says the market's likely to go down. So it's important that you get to distinguish these 2. Now, signal number 1, bullish engulfing and bearish engulfing. So at the top of a trend, when the market is moving up, you will see something like, you are likely to see something like this from time to time. You may see something like this. Market was going up, you saw something like this. Or market was going down, and you spot something like this. Assume this is a red candle. Just picked a wrong color. Something like that. This This is bearish engulfing. Bearish engulfing. This is bullish. Bullish engulfing. Now, the logic you need to understand is simple. Green candle is bigger than red, suggesting more buyers have entered the market. Because green candles are created by buyers. It means more bulls or more buyers have entered the market to the extent they have overpowered the number of sellers. And for that reason, we expect that the market will now change direction and start going up. Here, the same but reverse. It means there are fewer buyers than sellers. There are more buyers that there are more sellers that have entered this market, and they have overpowered the number of buyers at that level. And the expectation is the market will go down. In all the signals we are looking at today, you remember, number one, you must have a trend in place. Remember, you must have support and resistance. Remember, you must have a signal. Now, our signal in our case now is engulfing, the engulfing candlestick pattern. So, let's find a way of let's find an easier way of determining trend direction. You can do with higher highs, higher lows, the Dow's theory, or you can do with moving averages, like I sometimes like doing. Let me have my 50 here. Then I can add my 50. I can also add my 100. Okay, so we are done with the moving averages. So the next thing I need to do is I will have to add support and resistance. Let's go back in the past, somewhere like here. Where does this trend begin from? Somewhere like where they have crossed here. This is where the trend begins from. I want to assume. So I want to trade this this market. Let's say I joined the market when the trend has started from this vertical line. So I see the market go up, 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 create a resistance, come down, create a support, then start going up, create a resistance. Okay. So one thing is I drew this line, the market came down. I drew this line when the market went up. So I have my support. So I'm waiting for market to come back to my support. Remember, in an uptrend, we are trading at support level. So my focus is the market should come to my level. Of course, you should be able to go back and confirm this line works. You can see it worked as resistance here, as support somewhere here. So I want to see the market come back to this line and give me a bullish engulfing candlestick pattern somewhere here, very close. And if you look very keenly, you will spot one here. Bullish engulfing, correct? Now, my entry for a bullish engulfing will be 1 or 2 pips above the high of the candlestick pattern. The two, remember, this pattern has 2 candles. So I'll put about 2 pips above the 2 candles. My stop loss will be below the support. Below support. Not below support. You know, this, when I say support, I mean even this week's are also part of the support zone. So this is my stop loss. My take profit will be the next high, which is this one. Okay? So if you look at it, that would be from my entry to stop loss is about 26 pips. From my entry to take profit is about 60. So it's almost twice or 2.5 times my risk. My risk is here, about 30 pips. My reward is about 60 pips. 1 to 2 risk to reward. I cannot take a trade if I know the market will reverse from here. But I already know the market had made a higher level here. So this is a minor pullback. So I will not exit here. I will let the market go on until this level. Not exactly always, but I can even use a lower level. It's much better. I can use a lower level because the market does not always have to go to the highs. The market can actually stop somewhere here. Okay, so I'm still much more confident that the market will go that level. So I'll just exit at this point, which is 50 pips as opposed to around 27 pips. So still almost 1 to 2. I'm risking half of what I intend to make. So that is trade number 1 for bullish engulfing. So we keep going. Market goes, breaks above this resistance. I'm still looking for a bullish signal. I spot one. Now remember, it broke above this level and came back. You can see some movement up and then coming back. And somewhere here, you can see a bullish engulfing again. All right. So my stop loss will be some line. I'll put a line below this. So here, support is a bit far. Support is a bit far. If I try to put my support here, it's going to be a high risk. It's too long. So I'll put my support below the candles, the pattern. This is my stop loss. I'll put my entry 2 pips above, and I'll put my take profit almost double from my stop loss. Double my stop loss. Now the problem is, if I look at my stop loss, if it's too big, I will stop it. I will not enter the trade. Now, if I have to trade this, my stop loss is about 27 pips. Now, where is the next level? There's no level in the future. So nothing. There's no future. So even if I enter that trade, I'll exit along the way because I don't see any support or resistance along the way. Besides, my great worry would be when I'm entering this trade, this is bullish engulfing, yes, but this candle is telling me the opposite. This candle is telling me the market is going to go down. Are you seeing that? It's bullish engulfing, but it's a bullish engulfing after a shooting star. A shooting star tells you the market is likely to change direction to the downside. So that might filter the trade out, and I will not be able to follow that trade. So let's move on. But even if you enter that trade, there's no problem. You can cash out a few pips. Market comes down, doesn't give you a signal here, goes further down to where it started. This is where we picked our first signal. The trend is still intact. It gives you a clear bullish engulfing here. These two. And as I said now, we have this. If you take your entry above the 2 candles, the bullish engulfing, these 2 candles, where do you exit? You'll exit at the high. Now, remember, there are 2 highs. There is this high, there is this high. So I will assume that the first high might work, and I will exit at the same space over 50 pips. Even though the market might go up, I don't want to be too greedy because the market can reverse here. It had already reversed here. So I'll target here. So if the market goes up to that point, gives me that trade, I'm out, I have no problem with it. Then the market goes up, comes back to the same level here. No bullish engulfing. Here, there's a bullish engulfing. Now I'll enter my trade for this one. I'll exit at the high, another 50 pips. Market breaks, resistance comes back to support, bullish engulfing once again. I'll enter my trade and I'll make sure my stop loss is half my take profit. That's the logic. So if I say that my stop loss will be somewhere here, 20 pips, my take profit will be 40 pips above. So I'll keep going. So I've noticed a new resistance here that will be possibly used in the future support. For sure, market went up, created a new resistance. It's created some level here. Market comes back to my level, gives me a bullish engulfing. You can see it here, or you can see it here. It's not quite clear, but this green is bigger than red. So I can enter trade and exit at the high. Gave you another one here. There are other candlestick patterns here you can see, like a hammer is here, Morningstar is here. So you can use those, but for now we are looking at bullish engulfing. Market goes up, breaks your resistance, comes back to your support. Don't see any bullish engulfing. Oh, there's a bullish engulfing, but it's closest at this. This is like a Morningstar for sure. This is another Morningstar. It's not a bullish engulfing. So market goes above our resistance. We are waiting for it to come back. Didn't come. It gives us a new resistance here. a new resistance, comes back to broken resistance as support, gives you bullish engulfing, goes further up. Does it come back? No. Goes up, stops here and comes down. Does it give you a bullish engulfing? No. Breaks that resistance. Maybe this one. Does it come to give us a signal? No. So we keep on following it. I'm only waiting for resistance to be broken to become support. That's what I'm trading. Now we have a downtrend here. In our downtrend, if I drew my line from the past using this swing high and this mini support, then I would get a bearish engulfing here. You can see it.
Yeah.
There's a bearish engulfing here. Candle 1, candle 2. So I will sell from here. I'll sell from here. And where do I exit? Here. That will be about 74 pips. From here, I'm exiting here. This will be my next level to exit. I can see it. Otherwise, if you feel scared, you can exit here with 40 pips. This is still another level. You can exit here. Just ensure that your stop loss is always, no matter the case, keep your stop loss at a minimum of, if your take profit or your target profit should be at least 1.5 times your stop loss. So if your stop loss is 10 pips, make sure your take profit is 25 pips. No, not 25, but 15. If you are risking 20 pips, make sure you are also targeting 30 pips. It should be one for, it can be twice, it can be 3 times. Like when you see your target is 50, your stop loss is 20, that is even a better trade. Here you are risking far less, but you are going to win more if you are right. But never trade when you have a one-to-one risk reward. In other words, don't enter trade with the 20 pips stop loss and the 20 pips take profit. No. That's not very good. That's not very good. Okay. All right. We carry on. So now we have entered the downtrend and our first signal is here. Our first signal was here. Bearish engulfing was here. If you missed this, there's a larger one. There's a problem I told you with large candles like this, you need to avoid. I told you that. Large candles like this ones reverse the market for a moment. Okay, they are called exhaustion candles, more or less, or momentum candles, depending on where they are from. So you enter your trade here, you exit here, you make money. You created a new level here. Market came back to it, no signal. But market goes back to resistance again, where you traded from, and it gives you another bearish engulfing. You can see it. You enter trade, exit the same level, you make money. Market goes back to the same level. We don't see our bearish engulfing anywhere here. You can't see that even for yourself. So we keep moving. Market now is beginning an uptrend. We are done with a downtrend. Market is beginning an uptrend. Creates a support here, goes a little bit up, comes back and gives you bullish engulfing here. Where do you exit? After bullish engulfing, the next high, 46 pips. So that's how you keep tracking the market, with the moving averages and with this engulfing candlestick pattern. Does it sound easy?
But I have a question.
Yes.
On the take profit,
yes.
Why are you putting 2 pips? What is the significance of the 2 pips above the candle?
2 pips?
Yeah, above the candle. Because
the reason of having 2 pips above the candle is you want to be sure the market wants to go in that direction.
Okay.
Because there are cases where you'll get a bullish engulfing pattern, the next candle goes down immediately, and the market goes opposite. I think when we were studying candlestick patterns, you were able to see that. Sometimes the candlestick pattern will tell you there's a reversal, you enter trade, the market goes the opposite route. So I want to leave some 2 pips above. So if the market was serious about going up, it must go some pips above the pattern, or some 2 pips below the bearish pattern. Now, let me give you an example. This is a bearish engulfing pattern, right? This red and this green. I put my entry here. It is not triggered, as you can see, because the market went the opposite direction.
Yeah.
But if I entered the trade immediately, this pattern closed. This is a losing trade. So I want the market to indicate seriousness. That yeah, I've given you a signal with a candlestick pattern. Let me confirm to you that I want to go in that direction. Okay.
Yeah.
I'll give you another example where the market will play tricks. The market can play tricks on you, and you might lose some trades you are not supposed to be losing anyway. The good thing is you are trading the direction of the trend. When you are trading the direction of the trend, almost always engulfing pattern will work. Almost always it will work. But follow the 2 pips above when you are buying, 2 pips below when you are selling. You will see it save you a number of losing trades that people don't follow that approach end up losing. This is a bearish engulfing, this green and this red. Now, if I put my entry down here, my trade did not start because the next candle and the rest of the candles went the opposite. So my trade is not triggered, I'm safe. But had I put an entry immediately because I saw this resistance, this is a bearish engulfing, and I can sell, then immediately my stop loss would be hit because my stop loss would be somewhere here. I want the market to be serious that I want to go in the direction I told you. Then I'll be safe. Great. So using the same chart without deleting anything, we start from here. Let's go look at strategy number 2. If you have a question about strategy number 1, you let me know. Now remember, we have done these things with a minimum of 3 settings. Trend, we are following the trend. In an uptrend, we are trading as support. In a downtrend, we are trading as resistance. And number 3, we are looking for bullish engulfing candlestick pattern in an uptrend, bearish engulfing candlestick pattern in a downtrend. Nothing stops you from looking for other filters. Now look at this, for example. Look at this. When you want to take this bullish engulfing here, you can see it. We are following 3 rules. We are in an uptrend, we are at support, which is our support and resistance level, and we have a bullish engulfing candlestick pattern. Nothing stops you from adding other things. For example, the market started here, went all the way up, is coming back down. I might want to see what Fibonacci level was that. So I start from here, push it to the highest. What do you see? This pattern has formed, and this candlestick has closed back above 61.8. That might give you some additional confidence. Okay, it's one of the things that you might want to consider having on your chart. Then you might also want to zoom your chart back and see what else. Body to body, trend line. You see? From this, I've only connected those 2, as a matter of fact. Let me see whether I've drawn it the right way. Body to body. This is the body of this swing. This is the body. I had to zoom so that I can get the levels. You see, I'm drawing the line from the body of the candles. I'm extending it. Where did we get our signal? Exactly on a trend line. The bullish engulfing formed on a trend line. This is what we were learning yesterday, confluence. Confluence. So you see Fibonacci is telling me you can buy. We are at an important level. Trend line, we are trading a trend line bounce. So these are 5 things saying, for sure, think of buying. Consider buying. I have not even added volume. If I add volume, it's a different story. You see, the engulfing has formed with increasing volume. The volume has increased. The green candle, which is big, has more volume than the red candle, which is small. Okay? Besides, you also need to be aware that when the market is, remember, we are in an uptrend, so the volume is supposed to increase when market is moving up, and the decrease when the market is going down. Okay, so you need to be familiar with such concepts. If you are a fan of indicators, you can also add an indicator like RSI. It should be below 20, below 30. Is that the case? Yes. The pattern was formed when the RSI is below 30. Well, that's what people call oversold. So the RSI is saying for sure the market is likely to go up. Anyway, so that is it. So that is confluence trading with engulfing. Now let's look for strategy number 2, pin bars. So sometimes you would be waiting for engulfing, you don't see it, but you see the market change direction. So you need to have a number of strategies that when you're in the market, you can say, if I see a pin bar, if I see bullish engulfing, if I see this and this, I can enter trade. So welcome to strategy number 2, pin bar strategy. Same concept, we are now using a different candlestick pattern. Do you see a pin bar here? This one.
Yeah.
Put some 2 pips above the high of the pin bar. Let me zoom. This is a pin bar, right? You have an uptrend. We have support here, the same lines we had drawn before. We have a pin bar trying to reject support. You put 2 pips above the pin bar for your entry. Stop loss below the wick, below the body of, not the body, the entire candle, below the wick, somewhere here. So this could become, let me draw, this could become your stop loss. This is your entry. And the next level is your take profit. Correct? This level. If you check that, how much are we? Because we don't want to enter trade that's risky. How much are we risking? Around 20 pips. How much are we going to get? Around 30 pips. That's 1.5. It's a good trade. So you can go with that. That's trade number 1. If you are aggressive enough, okay, if you are aggressive enough, from your entry here, you could target the high, this one, or this one. But I decided to target the nearest high. So it's your choice as a trader to see what to do. Market breaks above resistance, comes back down. We are waiting for a pin bar to form. Hammer. This is a hammer or a bullish pin bar. It's called a bullish pin bar or a hammer. Market breaks above this level, comes back to the same level. Does it give us a hammer? Yes, there's a hammer here. Buy 1 or 2 pips above the high. So if I buy from here, my stop loss will be some below the wick, which is 13 pips, which means my target should be 26 pips, or at least around 20 something pips, 1.5. Ah, this one is even giving 30 very easily. So let's see. If this is 12 pips, what is 1.5 of 12? That's about 18. Minimum is I should make 18 pips from here. Yes, it can give me 18 pips. Or you may want to get double, so you go for 26 pips, which you easily get here. All right? So market comes back down and gives you another pin bar. I have a problem with this pin bar. One problem is the wick on top is also very long. I'm not comfortable like that because it means there's pressure from above and pressure from below. I like one where the wick above is so small. Those are the ones we took. The lower wick is very long. The upper one is so small. So this may not be a very safe trade. As you can see, again, even if you try to trade it, you didn't make much. Then the market comes back down to support, lower support. Now it's beginning to make lower highs, possibly like a downtrend. So I wait. We are still in an uptrend. No signal here. Down here, no clear signal because this is not a hammer. We have a higher wick, a lower wick, not very good. Market breaks above this level and comes back down to it. I'm looking for my pin bar. I didn't see it here. But remember now, while you are waiting for a pin bar, you also saw like a bullish engulfing or something else, so you could trade. Breaks above, comes back. Any hammer? No hammer. Breaks above, comes back down. No hammer. Later on, we get to see a hammer here. You see the hammer in this level. You can trade that and exit at the next. Sometimes you just exit at the next level. If you take this hammer, you exit at the next support or resistance and put your stop loss below here. Then the market breaks above, comes back down, no hammer. This is not a hammer. This is a spinning top or bottom. Those are not hammers. So, and the market keeps going just like that. Let's get a downtrend. In a downtrend, we are looking for a shooting star, the opposite of a hammer. Now, by the moving averages, the downtrend is beginning. I can see a downtrend already, but you see the moving averages are slow to change direction. So let's go to where they are clear. I've interfered with my line. Okay. So now clearly we have a downtrend here. The first shooting star is here on a resistance. You see it here? So you're entering some pips below. You can exit at the next level or take your stop loss 24 pips, multiply it by 1.5 or by 2. So if you multiply by 2, it will be 48. 48, your trade will end here, somewhere here. If you take 1.5, that will be around 36. Your trade will close around here. So it's still a profitable trade. Comes back to resistance, doesn't give you a hammer anymore. It changes into an uptrend. Immediately you get a hammer again, you continue. So the same way you can apply trend lines, Fibonacci, and volume and other things, you can do that to the hammer. Nothing changes, it's just a candlestick pattern. Now you need to remember, a hammer candlestick pattern demands that the wicks, this tail, is at least twice the size of the body, twice as long. And that's why this candle is a hammer, the next one is not a hammer.
Yeah.
I thought I should mention this because you might just end up picking wrong hammers. This is a shooting star. Also, the tail must be at least twice the body length. Okay? And for that reason, this is why this is a shooting star. The next one is not a shooting star. Are we together? Very good. So using the same chart, let's look at inside the bar strategy from where we start. I want you to see the same environment because you will have plenty of signals. This is a shooting star. But remember, you are in an uptrend, so try to avoid this. Okay. So now we are looking for an inside bar, mother and the sun, if you remember, a candle inside another candle. So at support, this is not a proper inside bar would look like this. A proper bullish inside bar would look like this. It will be a red candle with a green candle inside, with some green candle inside the red, completely including the wicks. Everything is right inside the range, inside that range of the red car. So that's like when you say mother and the son, or a pregnant mother, the child is hidden inside the mother. So that's the logic. So here, we are looking for a candle that has that similarity. So let's see one. Here is one. Also, you buy 2 pips above the high. Okay? Same logic, exit here or exit here. Same principles on where to exit. Then we keep tracking the market. Market breaks this level, comes back to this level. Do I see any candle that is an inside bar? Let me first clean these charts. Okay, let's scan. Market came back to the same support. I don't see any inside. There's an inside bar here. Do you see it? There's an inside bar just before we touch support. So you probably saw that before the candle moved to support level. Let me show you. So we have this inside bar here. This big red and the small green. And that's why I keep saying, don't enter a trade immediately. Enter after the break. So I will set my trade here. That the market must go above the pattern before, sorry, not there, but here. Do you see now the value of this? Because if you entered here, the market would have gone all the way to your stop loss, most likely. But now you put some pips above the pattern. Let the market do its own business, but when it decides to go up, it will break that level and continue up. That saves you. This would have been a losing trade if you just saw the, inside the band, enter that trade immediately, because the market would have continued going down instead. And if you had put your stop loss below support, you see, it would have been triggered here. You would have been lost. You would have been outside the trade by this time. But then the market now goes in the direction you predicted initially. So try to have a buffer of some 1 or 2, 3 pips above the candlestick pattern to save you a lot of losing trades. Great. Then we continue tracking the market to see what happened next. Went broke this level, came back inside here. No inside bar. I don't see it. We went and came back here. No inside bar, but there's one here. You see it?
Hello?
You're back, huh? I lost you for a moment. Huh?
Yeah, it is somebody who's calling me.
All right, so if you look at it, we have this pattern here. I think my logic is you buy above. So the market went down. When it decided to go above our entry level, it continued up. Okay? So what next? We keep going. We break that level, come back down. Now you know how to spot these things. Really, it doesn't have to be any. There's one here, inside the bar as well. There's another inside bar here at support. Let's get a downtrend. We see the bearish version of the inside bar in a downtrend. This is a downtrend starting here already. This is not an inside bar. No, that's not true. Let's see. There is no inside bar here. We come back to resistance. This is an inside bar. This one. It's an inside bar. Didn't give you much. This one would have clearly lost money. Not much. That's a loss. No problem. Losses are accepted in the market anyway. You should be ready to lose some trades anyway. You'll never win all the time. You will lose at some point. So there's a resistance here. And market came back to the same resistance. This is an inside bar. And that was a nice trade. An inside bar for this and this. So you enter somewhere below here. And your stop loss above the support or resistance would have been a good trade. The only problem is I don't like inside bars with many wicks like this. These are long wicks. Long wicks mean the market is volatile. I like solid trades where the candles are of reasonable wicks, not long wicks. Long wicks like pin bars or stuff like that, they're not good candles unless they are pin bars. You see, these are pin bar and another pin bar, correct? These are shooting star followed by another shooting star. Both of them are telling you the market will go down. But when you get double pin bars, not a very good signal also. So that's the inside bar technique. That's the inside bar technique. Now, trend line technique, trend line strategy. You can always replay the video to master the strategies. Now, let me remove the support and resistance so that I teach you the trend line strategy. With a trend line strategy, still identify an uptrend. We can change the currency now so that we have a new chart, USD card. Yes, you have a different currency now. All you need to do is identify 2 levels on the chart. First, ensure you have a trend in place. You agree with me this is a downtrend? The lines are sloping down nicely. So you need to connect. Like I told you, if you think you have a problem identifying those, just identify, put fractals. If you have a problem identifying those points where you need to connect, put the fractals. But really, you don't need them. But if you feel you need them, just put them. So you just need to identify a high and another high, then you connect them and wait for the market to tell you what it has to tell you. For example, you have to try this until you get it right. For example, if you try to connect this and this, I don't find it very useful. What I like is the line should be in where? Above the moving averages or between the moving averages, not below them. Because price is likely to come back into the moving averages. So a good trend line would be either above or in between. Better if in between. So then this point is good, but this point is not good. Maybe I'll use this other point, this one. All right? You can be sure if I put fractals, those will be fractals. Fractal, fractal, like I told you, these are fractals. Okay? So if I connect those two swing points, I wait for the market. So I've used this one and this one to draw my level. What I'm waiting for is the market to come back to the same trend line and give me a signal. That signal could be engulfing, that signal could be pin bar, it could be an evening star, could be whatever it is. Okay? Soon enough, we get a signal here. This is bearish engulfing. You recognize it. Bearish engulfing. My problem with this bearish engulfing is this long lower wick. I told you wicks indicate rejection. It means it's a bearish engulfing, but the market has rejected lower prices. So you may not expect the market to continue going down. So I will skip that setup. Try to draw a different level and see whether the market can obey that. Okay? So now I will adjust it when I see the market is doing that kind of stuff. This is my other level. This one, this is a fractal. Market came back and gave me, what kind of pattern is this? Bearish engulfing. Bearish engulfing. Now, with this bearish engulfing, where do you put your stop loss? Above the high, above your resistance. Resistance was from here. Support, support, resistance. So you put your stop loss above that. Maybe somewhere here. The next line. So you enter your trade from some 2 pips below the pattern. Where do you close your trade? The next level. Slightly above the next level. Is the risk reward good? If I enter here, my stop loss is 65 pips. My take profit is 65, 69 pips. That's not a good setup. It's not a good setup, if you ask me. I don't like such kind of setups myself. So I will skip it because I don't like 1-to-1 ratio. But that's how you analyze with a trend line. So let's pick another trend line. We are in an uptrend. I see this. I can't draw this because this is horizontal. A trend line should be diagonal. So I pick this and I pick this. Okay. I can also pick the tails and the bodies. So I just want to make it a little bit parallel. Because if it has wicks, I have to take care of the wicks also. So it has wicks, so I've used the tails, the wicks. So market goes, I have used this point and this point. Market comes back to the same level. What does it give me here? Morning star. 1, 2, 3. That's like a morning star. At the top of the morning star, you can buy 30 pips only. No good risk, no good reward. It's not a good setup. The reward is not good because if I'm entering from here, I would expect the market to go at least up to that point. But why? I don't expect it to go up because this is a high, this is a lower high. Clearly, the market is beginning a downtrend. From price action, the market is beginning a downtrend. It's now making lower high, so I don't expect it to go up actually. A signal like this you avoid because of this logic. We'll get a very clear setup that can become a model for you, for your trading. Oh, this line would have started all the way up there. This line could start all the way up there. If I delete this, I will have deleted everything. That's okay. You can lose all the lines. That's no problem. You can draw them afresh. So when this market started going down, I created a downtrend line like that. Then as the market kept on going, I can add new trend lines. This with this, a new line. This with this, a new line. So even this with this can give you a new line. You would find them useful the more you draw like that. So I am waiting because it's a downtrend. I'm waiting for a pattern to form on the trend line, and I take my signal. So here we have an evening star, green, red, red. This one, I'll exit the market around here. This is the next level. This is the next possibly support level. So I'll exit here. So if I'm going to exit here with 66 pips, my stop loss would be the next level above, which was here, support. So how much is that? That would be about 40 pips for a profit of 65 pips. That's good. That's at least 1.5 times. Then the market comes later, apart from giving you this signal, maybe you missed that. Later on, it gave you this signal here, bearish engulfing, this and this. And you can take that to the next level. Where is that? 47 pips. That would be the next level you can trade. About 45 pips. So if I take that for 45 pips, my stop loss would be the next level up. Where is it? That's not a good ratio. I'll skip that. It's not a good ratio for me. But there are times where I can enter a trade and let the market keep going, because I know in a downtrend the market can continue going down and break support. So I can still enter that trade and put my target below this level because I know this level is likely to be broken. Great. Remember, in a downtrend, support is broken frequently. In an uptrend, resistance is broken frequently. So don't always assume that the market, your target must be this. You can put your target lower because it's a downtrend, but the market is likely to continue going down. So market breaks this level and comes back. This was the swing point. So if you picked this trade here, also a bearish engulfing or bearish engulfing, this would have also given you a nice trade. When you exited here with 54 pips, what was the level above it? 54 pips, but this is the next swing, 28 pips. So this would have been a better trade. Why? Because this is the swing, the level before the pattern. This is the level before the pattern. And this level from this bearish engulfing was about 30 pips, but you are headed to make around 50 pips. That will be 1.5, I believe. So market breaks below, comes back to this same level. There's no trend line. So I'm not worried. I'm only trading trend lines only. So let me show you some more. So I see this and this. I draw my trend line and I wait for a pattern to form. Sure enough, we have a bullish engulfing here on the trend line, and the trend is up. I enter my trade here at above the bullish engulfing. I'll close my trade here 45 pips. My stop loss can be below the pattern. I just need to look for a swing. Yeah, you see there's a resistance that was there before. So this is a good level. So how much is that? From here to here is about 34 pips. Here to here is about 48 pips. That's at least 1.5 times. So it's a good trade. Or maybe I saw this one and I saw this one. Market comes, doesn't give me a signal, so no problem. Or maybe I saw this one and I saw this one. Market comes, doesn't give me a signal. Now we start a downtrend. In a downtrend, I can see this one. I can see this one. I can extend the line. I can extend the line. Doesn't give me a signal here. It breaks above it and continues. Not a good one. Then I can see these two, this and this. You can see that. That's what I'm talking about. This and this. This swing, this high and this high. I connect the two. It's a downtrend. bearish engulfing. Where can I exit? There's no support level, so just make it double or 1.5. If you don't see a level, just multiply by your stop loss. So here, if I'm entering here and my stop loss is the next high, which was somewhere here. So what would that be? That would be from here to here. It has to be here. This was the next level that was on the market. So I'll just put my stop loss slightly above the candlestick pattern here. So what am I getting? This is for 50 pips. Then it means I must target 75 pips or 100 pips. 75 would have been somewhere here, safe. 100 would have been further below. So still a safe trade. This line, now with the introduction of this new wick, I can adjust it so that it can include the wick. Market comes up to the same level, gives you an evening star. Evening star. Goes above and closes back below. This is an evening star. An evening star, you can also trade it. With it, just put some 2 pips or something like that above the body above the pattern as your stop loss. So here, about 71 pips. That means I must make 100 pips to be safe. Did we make it? Yes, we made it with that. So that was also a sure trade. Then as the market keeps going, I see this level, I see this level, I can draw another line and see whether there will be a trade. Sure enough, later on, the market gave me another evening star on the trend line, closed above and then closed back inside. And I can trade it. If my stop loss is somewhere here about 38 pips, I can look for around 50-something pips. So which sure enough, I was able to get even more than that. So that's how you trade the trend line. And as you trade the trend line, also remember you can add Fibonacci. You started from here, so push your Fibonacci from there all the way down to this level. You see, this pattern is forming right on 61. This evening is forming on 61. And it's also forming on a support resistance level. So you have so many things saying you can sell. So that is that. What am I trying to do? Oh, these things I've drawn them from MetaTrader 4, so I have to clean them from MetaTrader 4. All right. The other technique I was telling you is a breakout strategy. We looked at the breakout strategy last time with the Bollinger Bands. But now I want us to look at a breakout of support and resistance in the direction of the trend. This is a clear downtrend. You have a support. You have a support zone. The whole of this range is a support. I told you take care of the wicks as well. Now, what I'm looking for is I want the market to break below the level, below the entire zone, which happened with this candle. This candle was able to break. This candle was able to break below. Okay? So how do I enter my trade? My stop loss will be some pips above the support of the broken support zone. Above, actually. It will be safer to look for a swing high like here. This can become that can become your stop loss. Something like that. Or the next level that was in the chart. This was resistance. So that becomes your stop loss. You can multiply the distance by 1.5 to become your take profit. The distance from here to the candle, then that would be like somewhere here. If you're entering from here, I believe this is 1.5 times this one, roughly. And you were able to make it. I don't know whether you got that or you need me to use... I
used to factor in the two pips.
Yes. I always follow the 2 pips because I want the market to be sure. Yes, I don't just enter like that. I have to wait for the market to be serious about going down. And you can see from here, 2 pips, because this 1 hour, 2 pips are here. Almost here. Those are 2 pips. It's almost immediate, yes. So the market goes down. and you are waiting for another setup, you identify another support here, include the wicks. You see this range is support. This candle breaks. This is the candle that breaks your support. Okay? So because you know it's a breakout in the direction of the trend, it might work. So one of the things you might want to do is check volume. Did the volume increase when you were breaking out? Yes, volume increased. That might be a genuine breakout. And then you can enter your trade, taking note of the relationship between stop loss and take profit. Always. Don't ignore that. So let's look at a setup in an uptrend. Here is an uptrend, and we have a resistance here, including that. Resistance. This candle breaks above. Okay? But it's a very long candle. It's a very long candle. I told you long candles are crazy. So if it's a long candle and the next level is here, you don't enter trade because from past we know these are resistance. So market's likely to go and bounce from there. So in a case like this, let the breakout happen and wait for candles to come back to the same level. And give you a different signal. So in this case, you have a signal here in the form of a morning star. Now you can buy from there. Made some 30 pips, came back, 15 pips, went up to 39 pips. You would have made some profit out of this trade anyway. So that is one of the things you can do. Always when you're trading breakouts, check volume. This is a support. This candle breaks, check volume. Volume is high, green. Either enter immediately or wait for market to come back and give you the shooting star. Then now you can sell. If you asked me how I trade breakouts is I wait for a pullback. I don't enter immediately. I wait for a pullback. Let's pick a different pair. I'll show you what I mean. For every breakout, I wait for a pullback. That's how I trade. And I'm sharing with you the tips on how I trade, which is good.
Hello?
Now here, problem with my